Rule number 1, never lose money. Rule number 2, never forget rule number 1. Now, you may have heard that saying somewhere before. If not, you heard it here first. Warren Buffett, the man behind the quote, is no stranger to investing, and he's no stranger to making amazing returns in the stock market. His secret is that he's invested in the stocks for the long haul. Now, just because Warren Buffett does something doesn't necessarily mean that it's the right move for you to take. And we're here to help you navigate that. Now, we're not going to tell you what to do, but we're going to arm you with the knowledge that you need to make your investment decisions by yourself. In this episode, we're going to help you determine the length of time that is the best for you and your needs when it comes to your investment. Now, finance people typically look at investments in two different time frames, short-term and long-term. There is an in-between medium-term which some traders act on, but for the purposes of this lesson, we're focusing on just short-term and long-term investments. You may have heard about long-term a lot. In fact, a lot of folks recommend it. Hell, we do too. But we want to give you the insight on short-term investing because at the end of the day, that'll make your investment knowledge a little bit better rounded for you to take the steps that you need to take. Let's get started, shall we? Welcome to Snack on This. How long do I need to invest? We're going to start with short-term trading. Short-term is exactly what it sounds like. Trading or investing for the short term. You hold whatever investment that you're looking at, whether it's stocks, bonds, houses, shoes, and you hold it for the short term. In the finance world, short term typically indicates anything under about 2 years. For tax purposes, however, short term is anything less than a year. We are not tax advisors, so we will not be talking about the tax implications of the investment, but rather we're going to be focusing on the finance implications of the investment and what you're looking at from a finance lens. First, we'll start with the awesome things about short-term investing. All right, you can make tons of money very, very quickly. Now, this is a dangerous mindset to get into, but if it works for you, that's fantastic. With all of this coronavirus and COVID-19 going around, stock markets are fluctuating at a rate that's never been seen before. Because of these fluctuations, you're looking at returns almost on a daily basis that hit double-digit levels sometimes. This environment is great for people who are short-term traders because they can capitalize on more risky moves. Now, there are plenty of people getting burned on these moves, so you need to be careful, especially if you're starting out. But if you know what you're doing, then you can make great returns in a short amount of time because of the volatility or the ups and downs that we're seeing in this market. Short-term investing is also great because you typically have higher liquidity in short-term investing. Think of a savings account for an example. A savings account is a form of short-term investing where you can access your money at any point if you need it, but it also accrues interest at a higher rate than what it does sitting in your bank account. This lets you get your cash out quickly when and if you need it. The cons to short-term investing is that you're setting yourself up for increased risk. Risk are the ups and downs in the market. You simply can't predict, unless you've got a crystal ball, where the market is heading at any given point in time. So you're basically gambling. Short-term investing also ruins the return that you might get compounded over time. You may not see as much gain from your investment as you would in the longer-term approach because your money just hasn't had time to compound yet. Despite these cons, like I mentioned, there are amazing short-term opportunities that you can take advantage of right now. Like I mentioned, savings accounts. Savings accounts are great short-term vehicles for if you just need to park your money and earn money from the money sitting in your account. It's sitting there, so why not let the money work for you? You know the saying, let your money make money so you don't have to work for it later. Another idea of a short-term investment is a certificate of deposit or CDs. Almost every single FDIC insured bank offers CDs. You can get a CD by putting your money into a vehicle that is invested either for 3 months, 6 months, 9 months, or 12 months that offer you a little bit of a higher return than a typical savings account would. This is because you're locking in your money to those particular deposits or CDs, but at the end of it, you come out with a higher return. This is fantastic for those people that know that they're not going to be using that money for those specific time intervals or even greater, and they can just park it somewhere and have a higher rate of return. All right, we're gonna hit you with another Warren Buffett quote. Only buy something if you would be perfectly happy to hold on to it for 10 years if the market decided to completely shut down. He also said, beware the investment activities that produce applause. The great moves are greeted by yawns. As a forewarning, we know that we've shown a huge bias towards long-term investing on this episode, and it's because we want to set you up for long-term success instead of the short-term gains that may come from very, very risky positions. The chances are, if you are a short-term trader, you understand the risk that comes with it, and if not, we've definitely highlighted those earlier in the episode. Long-term investing is the edible finance way of investing. We highly recommend this approach, especially when it comes to you and your long-term goals for your portfolio, for your investments, and for your future. This way, your money can work the best for you. Long-term investments pick up where short-term investments stop. Typically, you're looking at investments that are more than 2 years. In the finance world, on the tax purposes, it's anything that you hold for more than 1 year. These investments let you experience what we call is the compounding effect. This makes your money work harder for you over the long term. And the great news is that you don't have to be as involved as you do with the short-term investments. Investing should be more like watching paint dry or letting the grass grow. If you want excitement, take that $500 and go to Vegas. Compounding works like this. Suppose you have $100 in investments and your investments net you 10% for the year. Now, at the end of the year, you have $110. Great. Now what? Now, for the next year, your balance begins at $110, regardless if you've put money in it or not. Sure, there'll be fluctuations up and down over time, but let's say you hit another 10% gain. Now your gain is $11, so you've gained an extra dollar. Now, that extra dollar may not seem like much, but give it 40 years. Your initial $100 investment has turned into more than $4,500, all while you sat back and watched your money work for you. You didn't have to lift a finger to get that return. Now, turn that starting amount from $100 to $10,000. You have now turned that $10,000 into $450,000 without doing anything at all. Seems like a good deal, right? So the pros are definitely the compounding effect. Your money works hard for you without you having to do anything. Sure, you can rebalance your portfolios. We'll cover those topics at a later time. But without doing anything, your money will grow on its own, and it'll grow based on the money that's in the account. You will not have to do anything on a long-term approach level. You ride out the waves with the returns getting smoother over time. If you were to look at a chart of the S&P 500 for this year, you would see up, down, up, down, up, down. But if you look at it over the past 40 years, you see a gradual increase. Of course, there are going to be major ups and downs in the market where you'll see larger blips, but for the most part, you're seeing a smooth sort of increase up on those charts. The downside to long-term investing is your money does typically get tied up for the longer term. So if you know that you won't need the money, or if it's an investment account that you're looking for long term, hey, great, invest in the long term and grow that money. The bonus here is you don't need tons of money to get started. As I've mentioned in earlier episodes, $5 a week, $10 a week, $50 a week, whatever you can spare will get you started towards that path. And with the frequent deposits, your base into what you invest only grows that compounding effect further. Some of the recommended long-term investments that we would tell you to do, or we would advise you to do, or we would educate you on are 401ks, IRA accounts, stock accounts, and property and houses. The 401ks, IRAs, and stock accounts will definitely cover in upcoming lessons for you. But we've already given you 4 ways to start investing, and then we've also given you 5 ETFs that you can start with on your investment journey. These are all in prior episodes, and you can check them out in the description below. If you like our content and find it very informative, smash that like button and subscribe to the channel for these weekly videos delivered directly to you. We promise they'll usually be no more than 10 minutes long and once a week. Until next week, have fun, enjoy the warmer weather coming up if you're in the United States, and keep investing.